some of the more advantageous benefits of an SBA loan for a small business owner is their ability to access the capital sooner and the ability to blend different uses of the loan proceeds into one longer repayment term structure.
Welcome to the Path to Owning It podcast by Provide, hosted by me, Corey Brown, a marketing leader at Provide with over a decade in supporting small businesses. Whether you're an aspiring or established founder, here you'll find tools and advice to start building your legacy and take your business to new heights. To help you achieve your entrepreneurial ambitions, each month, we'll tap into our unparalleled network of industry experts who will join us on our quest to provide the answers to your most pressing questions. Like what you hear? Follow us on Apple Podcasts, Spotify, or wherever else you listen. Today, I'd like to welcome Brett Howden to the show. Brett is an accomplished small business banking professional with over a decade of experience in credit underwriting, risk management, and relationship building. Currently serving as Director of Credit, SBA, at Provide, a division of Fifth Third Bank, he specializes in delivering tailored financial products to small business owners. Known for his analytical mindset and collaborative approach, Brett is dedicated to supporting small business growth and fostering trusted client relationships. Brett, welcome to the show. We're thrilled to have you on here with us today.
Thanks, Corey. Happy to be here.
Yeah, we get a lot of questions about SBA loans, and I think you're the perfect person to just kind of go through the basics with us so we can get an understanding of what that entails. So let's jump in. Can you tell us what exactly is an SBA loan and how does it differ from a conventional loan?
Absolutely. So an SBA loan is a small business loan that is partially guaranteed by the U.S. Small Business Administration, or SBA. It's issued by approved lenders, can be a bank, a credit union, or an alternative lender. And the program is specifically designed to help small businesses obtain access to capital where they might not qualify for conventional bank financing. Furthermore, an SBA loan usually offers more flexibility on the terms and uses that can be utilized for and comes with a fully amortized structure, so there's no demand or balloon payments associated with an SBA loan.
Gotcha. And, you had mentioned different types of SBA loan programs. Can you tell us a little bit about those and what they entail?
Yeah, for sure. So I'll kind of go through four main SBA loans or common types of SBA loans.
Okay.
The most popular option is kind of what we call in the industry the core flagship program of the SBA, and that would be the SBA 7A loan. Just to give you a little bit of context, as of this most recent SBA fiscal year end, that was just September 30th here a couple of weeks ago, there were over 78,000 loans that were approved under that 7A program. The aggregate amount of loans approved is somewhat staggering. It's in excess of $37 billion.
Wow.
So just to, again, kind of level set that is what a lot of people think of when they think of an SBA loan. They're thinking of that 7A facility. It can be used for a wide range of products. The working capital would be one of the areas you'll see a 7A loan for an operating business be advanced. Equipment purchases, real estate, either rent replacement, relocation, a ground up construction. You can also refinance business debt into a 7A loan. So one of the most common types of SBA loans would be that 7A loan. Another area that you'll see or you'll hear folks talk about when they say they got an SBA loan is an SBA 504 loan. So the 504 loan, different product structure, different application structure, but it's designed mainly for longer term fixed asset financing. Unlike the core 7A loan options, those loan options only involve a lender and a borrower. The 504 structure is kind of unique because it involves a lender, a borrower, and then a third party, which is a Certified Development Corporation, or CDC as we refer to them. That CDC is responsible for the underwriting and advancing on the SBA debenture. So the loan amounts for, when you hear people talk about a 504, and they'll maybe get a little confused that the loan amount on a core 7A is $5 million, or that's the cap in the program. The 504 loan can actually go up to 5.5. Can go a little higher with some exceptions, but that talks about the CDC or debenture portion of that loan, not the first part of the lender loan. So a little bit more unique, a little more specialized, but that would be the SBA 504 loan program. And then the other two programs that you'll most likely hear about when you're talking about 7A, it's been a lot of news and noise around the microloan program. So again, getting more access to capital for more small businesses. That program is designed specifically for smaller size loan requests up to $50,000. The average loan in the microloan program is only around $13,000. And it can help small businesses or certain non-for-profits. So that's a bit unique as well. It's one of the only SBA programs that allows certain non-for-profit childcare centers, for example, to start up or expand their program. And then finally, the last one is the SBA disaster loans. So these kind of came to the forefront. They've been around for a fair amount of time, but the economic injury disaster loan, or as more people are commonly referred to it, the EIDL loan, that is mainly something that is advanced during a declared physical disaster. So a natural disaster, think, tornado, hurricane, floods across the country.
Right.
They, again, were brought more to the forefront during the COVID-19 pandemic. And a lot of folks took advantage of the additional capital available through that EIDL program. The main difference in that versus the other three is that it is a loan that is directly advanced by the SBA to the small business and not through a lender. So a little unique, but those are kind of the four core ones. A lot of our conversation will probably focus mainly on the 7A portion. That seems to be, like I say, the flagship program that a lot of people have questions about or are looking to utilize. And then there's some also lesser known, more niche products within the SBA. International trade loans is an example of that. And then also just recently here in the last 30 days or so, the administration has rolled out their manufacturers access to revolving capital, or again, another SBA acronym, the MARC lending program. So that's part of their broader initiative to help the Made in America manufacturing come back to small businesses.
Yeah. Thank you for spelling that out for us so clearly. I have a question for you. As you said, most of our conversation's probably around the 7A. But the 504 sounds like that still could be an option for some small business owners. So can you talk about who would qualify or best fit for one over the other?
Yeah, absolutely. Qualifying for an SBA loan really depends on both the business and the borrower meeting certain eligibility requirements. The eligibility requirements are set forth by the Small Business Administration, SBA, and that's provided in their standard operating procedure. That is provided to all participating lenders. The most basic requirements that you're going to look for or you're going to hear about when people talk about qualifying or what is eligible for an SBA loan is going to come down to kind of 3 or 4 main points. One is that the applicant business must be an operating business located in the United States. It must be organized for profit, so it cannot be a non-for-profit. And it must be considered small by the terms defined by the SBA. So the SBA will look at that kind of on 3 different approaches. One would be industry-specific size standards. Another would be an alternative size standard. And then there's also some affiliation rules that help lenders like Provide, powered by Fifth Third, determine if the business meets the size standard set forth by the SBA. Another one that is somewhat new to SBA eligibility is that 100% of the direct and indirect ownership of the applicant must be held by a U.S. citizen, U.S. national, or lawful permanent resident. Green card holders, the common term there. That's changed recently with this most recent administration. It used to only be the majority ownership, had to be owned by a citizen, national, or green card holder. It is now 100% of the entity. So that's one of the major changes that we've seen in the program here in the last 12 months or so.
Now, you've mentioned that qualifying for an SBA loan tends to sometimes give more flexibility. So I'm wondering, if someone's in search of financing, do you suggest that they attempt the conventional route first and then move to SBA if that's not an option? Or am I not thinking about that correctly?
It would depend, Corey. I think conventional financing or traditional financing through bank lending has its place for a lot of things. Where I think SBA sometimes will get a bad rap is people truly don't understand the width of the program and how it can assist their small business in their loan request at the given time. So typically, you'll hear people say, what does the SBA provide beyond the access to additional capital? And I would classify that answer to be a little bit long-winded here, but there's a couple main points. One is that it's going to provide lower down payments typically than a conventional loan would be. It's usually also going to provide longer repayment terms, more flexible credit qualifications and requirements. And again, as I already mentioned, like a fully amortizing loan structure. So those are kind of some of the core benefits. But I personally believe some of the more advantageous benefits of an SBA loan for a small business owner is their ability to access the capital sooner than in a traditional lending environment, and the ability to blend different uses of the loan proceeds into one longer repayment term structure. So to give you an example, a small business who's looking to acquire owner-occupied commercial real estate, okay? the SBA provides, again, the width of the program. They'll say a real estate loan cannot exceed a 25-year amortization or 300 months. But if over 51% of those loan proceeds are related to the purchase and or improvement of that real estate property, the lender and the borrower can also include loan funds for traditional operating capital or equipment and machinery needs that are going to be in the new space. And that can all be blended into one loan over 25 years. Whereas if they went to a conventional lender and said, hey, I need working capital, I need equipment, and I need a loan to buy the building, they're probably going to get 3 different loan products with 3 different amortizations. Your equipment and working capital are going to be 5 to 7 years of amortization. And then your building is going to be most likely 20 or 25 years.
Gotcha. Yeah. No, I think that makes a lot of sense. We keep saying small business and kind of these general terms, but are there any specific industries that tend to find that SBA loans meet their needs more over conventional loans?
Again, great question, Corey. The industries that would historically be classified as higher risk by your traditional conventional lending groups, those would be the ones that most likely find their way into an SBA loan quicker than someone else. So those industries, again, typically your hospitality, restaurant space, construction or general contracting, and then retail, including e-commerce now.
Okay. And opposite of that, business types or industries that maybe would not be as well suited for an SBA loan?
So that list can be somewhat extensive.
Yeah.
The most common types of businesses and industries that aren't suited for SBA loans are obviously non-for-profit right away, doesn't fit the program.
Right.
Any business that is foreign-based, again, that doesn't fit the program. Any passive business, so not an active operating business. So think investor real estate is not eligible. And then it gets back into kind of anyone who's had a prior loss to the government because it is a federal government program. You can't qualify there. And then the ownership, again, being citizenship, U.S. nationals and legal permanent residents.
And, if we're thinking about applying for an SBA loan, what kind of documentation or prep should we have ready before approaching a lender for an SBA loan?
So being prepared for an SBA loan in the application process is probably one of the areas that we see differentiates a smooth process for an applicant or a small business and one that can be a little bit more bumpy. If someone is ill-prepared or ill-educated on what they need going into that application process, you can see an elongated approval, you can see an elongated closing time, and things just seem to be a little bit, like I mentioned, more bumpy. If you're a small business that has a good relationship with your lender, a trusted advisor who is an industry expert, or someone who can help prepare you before you send that application in, it's just going to make your life a whole lot smoother. So, what are we talking about in those terms? Usually it's going to involve a business plan and financial projections. So the business plan is very important for a lender if you're starting or acquiring a business, because they're going to want to see what your take is, like say on the acquisition side of how you're going to manage that business going forward. If you're starting it up, that's really your roadmap, right? That's going to outline your SWOT analysis. It's going to outline your competitive advantages. It's going to outline your marketing strategies. It's going to really tell your lender that you've put the time, effort, and thought into this, and that roadmap will lead to success going forward. So you have to have the business plan, financial projections with assumptions would be a good thing. A solid understanding of the amount that you're looking to borrow and the use of those funds is obviously crucial to a solid application as well. And then we kind of get into more business and personal documentation as well. So 3 years of tax returns if you're an existing business, 3 years of tax returns for the personal guarantors are going to be required, interim financials, business debt schedules, personal financial statements, and then most lenders as well will have an initial application or intake form that they're going to utilize. That'll help them collect some of those specific details about your loan and the background and disclosures of the individuals involved.
Yeah, that's great, Brett. Thank you for breaking that down for us. Sounds like the more organized one is up front, the smoother the process will be. Next, we'll get into all the details, but specifically how the fees and repayment terms compare to other financing options and why many entrepreneurs find SBA loans can be more favorable. More with Brett right after this short message. Are you fresh out of school with big dreams and ambition to achieve them? Or is your current business bursting at the seams and it's time to expand your legacy? If you tend to challenge the status quo and shoot for the moon, Provide's SBA loan may be for you. Our dedicated team of small business experts will work with you to make your ownership dreams, no matter how big, a reality. To get started, visit getprovide.com to see how our tech-enabled small business financing and banking can work for you. Again, that's getprovide.com for when your aspirations of business ownership exceed traditional limits. I'm Corey Brown, and this is Provide's The Path to Owning It podcast. We're back with Brett Howden, Provide Director of Credit, SBA, to get into the costs and the benefits of an SBA loan and why it might be right for you. Brett, $1 million question. Everybody wants to know how much these things cost. What are the fees, interest rates, repayment terms as it compares to other financing options? I'm sure this varies quite a bit, but can you give us an idea here?
Yeah, you're absolutely right, Corey. It can vary across the different programs, as I mentioned earlier. Sticking with that core 7A, the flagship program, we'll dive right into interest rates. So the SBA sets a maximum interest rate cap for loans that are approved under this program. The interest rates can scale with the amount of the loan facility that is being approved, but the participating lender cannot charge higher than that interest rate cap. So just to give an example, a loan that is above $350,000 all the way up to the program current limit of $5 million is going to have an interest rate cap of Wall Street Journal Prime plus 3%. That is the maximum margin that any participating lender can charge under the program. What is a typical loan cost? It varies, right? You've got different lenders that are charging different rates, and it could depend on their risk tolerance, the industry, the collateral, the repayment strength. But I would say, to give kind of that blanket statement, what is a typical 7A loan cost? It's going to be anywhere from Wall Street Journal Prime, which is currently 7.25% at the time of this recording, up to that cap of Wall Street Journal Prime plus 3.
Okay, gotcha. And let's, for an example, I'm looking at different lenders for a loan. If someone has prime plus 1.5% versus prime plus 2%, I guess what else should I be looking for besides interest rate when I'm trying to make the right decision as to who to finance with?
Yeah, another great question. I think the interest rate is an integral part of any financing application, whether that's conventional or SBA. But one of the things that I would recommend to anyone who's looking into this is that don't just be blinded by a shiny interest rate, right? The interest rate is important, but the terms, the servicing, the relationship, we'll call it, with the SBA lender is as important. Also, I would challenge someone to say, do your own due diligence, do your own research with the lender that you've chosen. There are a lot of lenders in this program. The top 75, I believe, in the country are going to do each in excess of $100 million. They're going to do at least 125, 150 loans a year. So make sure you're working with someone who has dedicated staff, dedicated subject matter experts that know what they're doing, not just on the front end in showing you a term sheet or an application with a shiny interest rate, but also the underwriting, the closing, and the servicing of that loan. Do your own due diligence, understand that there's more to it than just the interest rate. If you want to jump into the fees aspect, most lenders are going to charge the $2,500 packaging fee. That's become pretty standard in the core 7A program here in the last 24 months.
Okay.
And then the guarantee fee is something that depends on the loan amount, but it does not depend on what lender you're going to utilize. So that is set by the SBA. Again, it's based off the percentage of the loan that is guaranteed by the federal government. And then there's a calculation that goes into it. So to give an example, I think anything under $150,000 is 2% guarantee fee. Anything that is, north of $700,000 up to the $5 million cap is going to have a 3.5% guarantee on the first $1 million, and then a 3.75 guarantee on the remaining portion above that.
Gotcha. Yeah, thank you for sharing that with us. We've talked about this a little bit, but just to kind of be real clear on this topic, what types of business needs really are SBA loans best suited for? I mean, we've mentioned like startup costs, real estate, working capital. Is there something else that maybe we haven't mentioned as well?
Yeah, you're going to, if you haven't already heard a lot about this kind of silver tsunami and the change of business ownership, and transfer of wealth is another saying you'll hear out there in the marketplace right now. So SBA loans are very, very good vehicles for folks looking to acquire small businesses, right? Traditional conventional financing is going to look at cash flow first. We always look at cash flow, but then they're also going to look at the collateral component to a loan. A lot of these industries, service-based industries, childcare is another one. There's not a lot of fixed assets to these loans, so they can cash flow the requested debt repayment, but they don't have the collateral to support it. So you have transition risk, you have a lot of things that go into that. And you'll see a lot of folks right now in social media, but also, across the board, pushing that an SBA loan is best for that kind of change of ownership transaction as well.
We talked about how being prepared for an application really improves the speed and accuracy of how that process goes. So let's assume that I'm very prepared. How long does the SBA loan approval process typically take? And can you go through kind of the main steps that are involved with that?
Yep, absolutely. Again, we love the as prepared folks as we can, right? Every
Sure.
lender is going to say that. So nowadays, I would say you've kind of got a two-step process in place. I'll start with that initial credit approval. The initial credit approval is somewhat lender specific. So typically in a non-government shutdown lending environment, that could be anywhere from 7 to 14 calendar days. That's pretty atypical to the industry turn time. It's dependent on that lender, again, receiving that full financial package on the front end, making sure that they can work through their internal credit policies and guidelines and structure your approval appropriately within that desired time frame. The second step to the approval occurs during the closing process, but it's the participating lender formally getting the loan number authorized or approved by the SBA. So that is now known as the terms and conditions, and we get an SBA loan number. It's become a little bit more cumbersome. It's somewhat out of our control because it does do some eligibility and background checks against the core requirements of the program. You'll hear of some stories where it's delayed anywhere from 24 hours to a couple weeks. But ultimately, I would say, that front end credit approval by someone with a PLP designation in 7A lending is going to be approximately a week to 2 weeks.
Gotcha. And what are some of the biggest challenges or maybe the common mistakes that small business owners face when they are pursuing an SBA loan?
So on the front end of that, you're going to hear folks not really understand a lot of the core requirements in the program. So it could come back to choosing the wrong lender, not having someone who has a dedicated staff that understands the program requirements from all of the eligibility rules that govern the 7A lending program, the all available collateral rules that potentially could be in play for secondary collateral support, the financial requirements package that you are expected to have submitted to your lender to underwrite your loan. So there's, that kind of first aspect. And then also on the back side of it, let's go post-approval here and maybe even post-commitment. It's not having the right trusted resources in place to help facilitate the closing process. So we recommend, and I think a lot of lenders in the program recommend, that you have the right players at the table to help you get that loan to the finish line. That's going to involve an attorney, most likely. It's going to involve your CPA, most likely, right? It's going to have your lender, your banker as well. But we're looking to work through that list together in stages and ensure that everyone knows exactly what they're expected to do to get your loan to the finish line and get your 7A approval out the door.
Brett, final thoughts here. Just curious, what should a business owner really consider before taking on an SBA loan? And how do they really know if it's the right move for their business?
Great question, Corey. I'm going to say, it may be something that is quasi-controversial here, but do your own due diligence, right?
Yeah.
Don't rely on AI. Don't rely on posts that you've either seen on social media or even potentially a podcast. Make sure that you're doing your own due diligence and considering if that is the right path for you and your small business. To give an example, in Provide powered by Fifth Third, we do a lot of healthcare lending and we do a lot of project finance. So a lot of folks won't know the exact way to go about that. They've just heard of, either peers in the industry or folks in the industry taking on conventional project financing, but they need to explore an SBA option because it allows them potentially that lower down payment, as low as potentially zero for an expansionary play. It allows you that longer repayment term. It allows the potential for fixed interest rate financing. Again, some folks don't know that certain lenders will offer fixed interest rates in this space. And that gives you the payment certainty and the cash flow certainty as you go into that kind of new project or new space that you're looking to build out. So, just make sure you're doing your own due diligence. If you haven't consulted with a lender, make sure you're consulting with a lender who specializes or has folks specialized to the program. They can help educate. They can help set up you and your small business for success with an SBA loan.
Yeah. That's great, Brett. And I just want to thank you so much for sharing your expertise with us today. I think you really gave us a good look into SBA lending and why it might be a perfect option for a business owner for their financing needs. So thank you so much for being here.
Appreciate the opportunity. Thanks, Corey.
Thanks for joining us. The path to owning a business is a nuanced journey. We hope you discovered something in this episode that eases your path to success. If so, leave us a review on Apple Podcasts or Spotify. Have a topic you'd like discussed in a future episode? Drop us a line in the comments section or send us a message on social media. If you're ready to take control of your future and start building your legacy, be sure to visit getprovide.com. You can view our resources page for more helpful tools, learn how our all-in-one financial and banking products can help you on your path to business ownership, and pre-qualify for financing in under 2 minutes with no impact on your credit score. The Path to Owning It is brought to you by the team at Provide, and it's produced by PodCamp Media, branded podcast production for businesses. PodCampMedia.com. Producer Dusty Weiss, editor Emily Kasinger. For Provide, I'm Corey Brown. Thanks for being on the journey with us.
Provide is a division of Fifth Third Bank, National Association. All opinions expressed by the participants are solely their current opinions and do not reflect the opinions of Provide, its affiliates, or Fifth Third Bank. The participants' opinions are based on information they consider reliable, but neither Provide, its affiliates, nor Fifth Third Bank warrant its completeness or accuracy and should not be relied upon as such. This content is for informational purposes and does not constitute the rendering of legal, accounting, tax, or investment advice or other professional services by Provide or any of its affiliates. Please consult with appropriate professionals related to your individual circumstances. All lending is subject to review and approval.